Well, to take now a closer look at the trends that we've been seeing this earnings season, I'm joined by UBS's European equity strategist, Nick Nelson. Thank you so much for coming in. Overall, we actually had quite a good crop. A lot of the other analysts have been telling me, well, sure, we've had a good crop, but it's the guidance that worries them the most.
Yeah. So we've tracked at UBS about 100 companies so far. 18% have had clear beats and only about 5% have had clear misses. So, yeah, I think it's fair to say on balance they're stronger than expected. We are seeing, however, the profit cycle mature, and what we're seeing is that revenues are coming in very strong, but in some cases margins are coming under a little bit of pressure. All these input costs, we're just hearing about high commodity prices, oil prices, cocoa prices, grains, wheats. So I think that's starting to take the shine a little bit off margins.
And Nick, actually, will the margins continue being under more and more pressure? Because, of course, growth isn't spectacular, and at the same time, as you're saying, their own costs are rising.
Yeah, I think the margin forecast from bottom-up analysts, which are expected to expand in 2011, 2012, 2013, I think they're just a bit aggressive in the amount they're going to expand. So I would expect corporates to have higher profit margins this year than last, by perhaps not by as much as the consensus expects.
Now, if we look at the earnings that we've had, is there any sector that actually outperformed your expectations?
Well, the autos have done pretty well, to be fair. We've been a little bit more cautious on autos because we think, you're seeing some rollover in some of the momentum there. But this reporting season has been pretty strong, it's fair to say. And the ones that have disappointed, I would say, is telecoms. Obviously, we had that warning from KPN a week ago, and to me, that looks a bit nasty. What
about banks? Because we've had actually different fortunes depending on the country, depending also on what division they've been focusing on. It does seem that it's getting a little bit better in terms of earnings, but we still don't know the regulatory framework.
Yeah, I think that's right. I think we are improving. We're moving out of a recession. There is a recovery. There's a little bit of loan growth, not much, but a little bit of loan growth in patches across Europe. But you're right, the key issue is regulation. And until we know what these core equity tier 1 numbers are going to have to be, what type of capital banks are going to have to hold, it's a difficult sector.
How do you actually choose a company, Nick, or a sector? We were speaking to Jim O'Neill, chairman of Goldman Sachs, and he says, he's trying to distill into his investors that the world has changed. We're not pre-2008 anymore. Have you had to change your perception of companies? Do you depend more now on who's actually at the top, or do you look at just fundamentals?
I think you look at pricing power, because these rising input costs are very broad-based. They're coming from hard commodities, soft commodities, across the whole scale. So you need to find companies that can push these prices through onto their end consumers. In general, I would be happier on companies that have corporate spending rather than consumer spending at the end, because I think consumers are being squeezed by higher oil prices, higher taxes, and potentially higher interest rates.
And how much of an effect does the European debt crisis have on earnings and your perception of companies?
Well, I think it gives you very much a 2-speed or 3-speed Europe, with the periphery economies, the Portugals, Ireland, and to a degree Spain, obviously growing much more slowly than the powerhouse that's Germany. So I think you have to look at your geographic exposure within Europe.
Nick Nelson, thank you so much for joining us.